Okay, the value of the firm. There are three components to the value of the firm. First is market factors, or that's comes economic conditions, government regulations and rules, and then the competitive environment. So, economic conditions. We currently have a problem with inflation, and my personal opinion is that it's caused by a combination of the government overspending and the Fed's mismanagement of the money supply. So the Fed has made the cost of borrowing too low for too long, and we, with regard to government spending, we pumped money into an economy that wasn't operating at full capacity. And as a result, when you have too much money available, it means that the prices of goods are going to go up. We still have supply chain issues which were created during COVID. So, government regulation rules. In the previous lecture, we talked about the regulations with regard to banks. This is specifically related to reserve requirements and so forth, which they face that raise their cost of capital. The result is that corporations in the U.S. borrow from the bond market much more often than they do from banks. Then the next factor is firm factors. We have operations, financing, so capital structure, the debt equity decision. So debt is beneficial to a point. At some point, it becomes a burden and will overburden the firm. Investment, capital budgeting. So what do we invest in? We need to invest in projects that earn a return that is at least the firm's cost of capital. So those combined together create cash flows. Then we go to the other side, investor factors. We have income and savings, age and lifestyle, interest rates. We're seeing interest rates climb right now. Risk attitudes. When investors face uncertainty, they become more risk averse. These combined result in a rate of return. So if we look thinking about the current state of the economy, cash flows have certainly been affected because there's increased costs and there's limited availability of a lot of products. So then on the other side we have greater inflation, more uncertainty, so forth. That means that the rate of return is going up, cash flow is going down. That means the value of the firm has likely fallen. Some firms, just about all firms have fallen substantially. Some much greater than others. Factors influenced by managers that affect stock price: cash flows, the timing of cash flows, or projected cash flows, timing of cash flows. Sooner is always better. Risk of cash flows. The more risky, the higher return that the investor is going to expect. The use of debt. So the managers have to find that optimal debt structure that reduces the firm's cost of capital, but at some point, there's a point where that the company will become overburdened, and the use of debt becomes a negative. Dividend policy. We talked about dividend policy, being paying out dividends when there are projects that exceed the company's have returns that exceed the company's cost of capital will actually reduce the value of the firm or the potential for growth. We touched on this before. Agency relationships. This is also referred to as the principal agent problem. An agency relationship exists when you have a principal or an owner that hires management to act on his or her behalf. So when you buy stock, you are a principal, and you have effectively hired the executives of that firm to act on your behalf. An agency problem results when the management makes decisions that are not in the best interest of the owners. So what do we do? So managers are naturally inclined to act in their own best interest. We have to incorporate mechanisms. We mentioned this in earlier lectures that align those and provide incentives for managers to act in the best interest of the shareholders and of the corporation. These come in the form of compensation, stock options, shares of stock, so forth. The threat of shareholder intervention, the threat of takeover. So if a firm is operating inefficiently, that means that the value of the firm, the market value of the firm, is going to be below what it should be. It'll be, if it gets too close to the book value of the firm, that are to the point where the book value of the firm is greater than the market value, it's obviously a takeover target, because the firm can be bought and liquidated. It was very common in the 80s and early 90s to buy firms and liquidate them because they were operating inefficiently, and they could be bought and sold at a profit. This was the basic model of your corporate raider. The firms can also be bought and management removed, and try to add improve operations, improve the performance of the firm. We will start lecture 5 on talk about business ethics.